So
Excellent. Well, let's go ahead and get into it. And we were joking before we went live. Not a lot of great news in the headlines for the mortgage industry to discuss right now. So let's start. Fannie Mae does their home purchase sentiment index monthly, basically weighing the sentiment of potential home buyers across America. And just 25% said it was a quote unquote good time to buy right now. That's the lowest in the history of that index. That's never a good thing. And the pessimism, even stronger with younger consumers, wannabe home buyers between the ages of 18 and 34. 83% said it was a bad time to buy a house. Only 14% said it was a good time. A lot of frustration out there right now amongst people that want to buy homes. And it seems like that frustration is amplified amongst young people. It's kind of like a sign of the times right now. It's not a great time to buy a house right now.
I was talking to a friend that's my age, so I'm early 40s last week, and he said, they told their realtor to just quit sending them stuff unless it was exactly what they wanted. They're in a position that they're planning on keeping their existing house and renting it and buying a new house to live in. And they said they just got tired of the prices for stuff that wasn't what they were looking for. And he was like, I just told them to quit sending me emails, and whenever they find exactly what we're looking for, we'll jump. But I think that pessimism is falling over. And then, like you said, we've got all this news. Every survey says things are bad and people don't want to buy a house, but we've also got the economists telling us that this is going to be a record year for purchases. So I don't know how those two numbers are going to add up.
The economists they can never figure out the mortgage industry. It never right. And, I think this year, they were, most economists were predicting an 8 to 9% tick up purchase transactions versus last year, and rates to slowly ascend to the level that by the end of the year that they hit on like January 10th. So right out of the gates, a couple curveballs for the mortgage industry and wannabe home buyers. And it doesn't seem like there's any end in sight to what's going on right now. Home values just keep going up because there's this great divide in America, but kind of between the haves and the have-nots, and especially as it relates to home ownership. And people are still buying homes. The homes that are out there are getting bought, but you just see values keep going up. And then now the interest rate part of it, the average mortgage payment right now, so if you take the average size loan amount and the average 30-year fixed rate, $1,454 per month. That is up 32% year over year. The average housing cost for somebody that wants to buy a house right now, pretty significant impediment to home ownership, except for at the highest ends.
Well, like we were talking about beforehand, that I've always worried about, when all the refi started in 2020, were we kind of robbing from our future a little bit? What's this look like long term? And then how does this, this sentiment right now affect long-term wealth accumulation in America? Home ownership is typically the biggest vehicle of someone's net worth. And if generations not able to buy in, life's great if you bought in at those levels in 08 and rode it, but that's not good long term. And like we're talking, I don't know how you fix that from a policy standpoint, but it definitely is going to have bigger impacts.
Joke all the time. Housing a lot of times doesn't make the national headlines. It typically doesn't make the stage for like presidential election debates. But right now, you go to pretty much any major media outlet in America, and somewhere on that front page is a story about, the just skyrocketing costs of housing right now and the impediments to home ownership and all the tentacles to that right now. And it just would be fascinated to be a fly on the wall of if it's Marsha Fudge's office or Sandra Thompson or any of these really key housing leaders in America right now, because the change that they wanted to bring to housing in America to break down the home ownership gap and to make home ownership available to minorities and people of low to median income levels in the areas they live, through no fault of their own. It's slipping away. It's getting worse and worse and worse each month. And we're almost certain to see some type of government intervention to this problem, because it's getting to the point where it's going to be an election issue in November for the Democrats. And there's no easy answers to this issue though right now.
I mean, how long have we been struggling to figure out how to take the GSEs out of conservatorship? And now you've got, at least this wasn't necessarily policies that got us here. I mean, it was the market forces led us here. But yeah, I don't know how you intervene to slow that.
Yeah, you were kind of talking like we made our bed, right? And the Fed, just the hyper aggressive buying of mortgage bonds. And I remember like every Fed meeting, there was a couple of the Fed governors that were really giving Jerome Powell a hard time. Like, why the hell do you keep buying so many goddamn mortgage-backed securities? And, he had good justification for it at the time, but you're right. What you said earlier is so true. In addition to all these other issues with housing right now and the impediment to home ownership for somebody that doesn't own a home or somebody that's renting, rents are skyrocketing as well. You have those current homeowners that are able to be in prospective like move up home buyers that now they're locked into a 30-year fixed rate in the twos that was artificially lowered by Fed bond buying. And now, in addition to paying more for the next house they want, you got that big bump up in interest rate, and it's just kind of salt in the wound.
Well, then that goes back to your, affordable housing issue and first-time home buyers. If the people who are in their first home and are, they're locked out of trading up into a new house, I don't know that we can build our way out of this, because there's not enough margin left in home building unless it's a really big player to have some scale that can afford to build an affordable house now.
Yeah, exactly. I mean, and I think that's got to be part of the solution on this, is some sort of incentives or reduction of costs or regulation or fees for home builders to build lower priced homes, to build homes at or below median average, home value prices, because the home builders they've never done that. And I think that's helped bring us to where we are in terms of the lack of affordable housing in America, especially now with the supply side constraints. All these home builders are public companies, so you can listen to their earnings calls. You can get a look right into their business model, and they vacillate a little bit, but they're all essentially saying the same thing. Supply issues continue to be a real challenge for them, so they're not doing what you said, which we kind of need, right? And building gobs of homes and making big speculative bets, because one, the cost of supplies is so high, and two, values are so high. There's some of that fear factor, right? Remember like 06, 07, 08. I remember you do business in Florida. I was with the bank at the time, did business in Florida. People were building homes in Florida in like 07 and building an $800,000 house. And like when it was halfway done, the home was, all right, now the home's worth 500,000, and people are just walking away from a half-built home.
Yeah, you can't really blame the builders. They took it pretty hard last time, and I can't blame them at all for trying to be conservative. And just from a timing perspective, it's kind of hard to build your way out of this. I've been trying to find good news. I guess in the survey you're talking about, there was some good news. That was it 63 or 83% of the respondents thought it was a good time to sell. If that's the case, maybe that's how we fix the supply thing. If everybody gets the idea this spring of let's list. I think a lot of people stayed on the sidelines because they knew they could sell their house immediately, but they couldn't find something else. So it's kind of a chicken and the egg. Somebody's got to move first. And if people start listing, then maybe that helps us out a little bit.
Yeah, because right now I saw the stat in some of the notes just prepping for the show. Total home inventory for sale right now in America, it's less than 300,000. That is less than 50% of what it was right just before the pandemic hit. That's crazy. I mean, that's a 55% drop in the amount of homes nationally that are for sale.
Well, and it's not like inventory was at a great level before that anyway. I mean, that was our biggest problem in the 19 market, was a lack of inventory, a lack of affordable inventory. There's nothing for first time home buyers to buy, and now it's twice as bad.
That's a great point. We were bitching about inventories 2 years ago.
Mhm.
They were, oh my God, it's 3 months supply, 4 months supply, whatever it was. And now we're at less than 50% of that level, with interest rates higher and home values higher. And it's again, because you just know how these things work with politics in America, because it's starting to really affect and touch and reach Joe American and reach the news headlines. And then you've had a very aggressive administration, just in terms of the rhetoric on things they want to do with housing. It's going to be so fascinating to see what happens, because I think you're going to have potentially like unprecedented, not counting the meltdown, levels of government attempted intervention into our industry, into housing, to try to fix this issue. And nobody, including you and I, can sit here and intelligently speculate on what it might be.
Well, and it just historically, every time we try to intervene and stop a market, it usually isn't just a gentle correction of any sort.
Exactly. Let the market forces play themselves out. But I doubt we'll see that. It's going to be interesting to see what happens. And we'll be tracking it one Tuesday at a time on this show throughout the course of the year. So some more positive news, even though it negatively impacted mortgage rates. The jobs report last Friday was really good. And I haven't looked at the 10-year in the last few hours, but it was like at 196 this morning, approaching that the kind of watershed 2% mark. But that's the other part of it too, is like the economy is chugging along. It really is. And that's putting more pressure as well on bond yields and mortgage rates.
Yeah, I mean, people, job creation is a good thing. Well, you got a problem if rates are low but nobody has a job, then that doesn't do anybody any good. So, I mean, that is a bright spot in there that we're getting folks back. So, I don't know, maybe that was a goal of this administration, to hit that mythical full employment number. We'll see if we get there or not. Then what it costs us to get there.
This is the last week in Mortgage Today. I'm Rich Swerbinski with the Mortgage Collaborative. This week, joined by the president of mortgage lending for Centennial Bank, Keith Little. Keith, on a more humorous front, the mortgage broker channel, like, it's just, being an organization of really not any mortgage brokers and just kind of watching that piece of the industry from afar. It's just been one amusing, interesting headline after another. And it was about a year ago, United Wholesale with bend the knee, you sell the Rocket or Fairway, you can't sell to UWM or we'll sue you. And I kind of speculated that he can't really start suing all these brokers. How's he going to check it? Well, he's suing brokers.
Yeah, I mean, I hate to make any comments that it end up getting me sued, but it's an interesting business model. But on the flip side, you got to read the contracts and the agreements you sign, and it looks like a lot of people signed agreements that kind of joined them at the hip to UHM, and it looked like they didn't. There was no capital in going after the people that just did a little bit, but the ones that did a lot, they seem to be. I'll say it's going to be interesting to watch, and I'm going to be happy to be on the sidelines to watch it. I hope it doesn't create just some media coverage that paints an entire industry with broad strokes, and brings negative attention to the whole business.
I hate that, because it seems like at least once every 2 or 3 months, there's some sort of if it's the better.com guy, Zoom firing people, or Ishbia from United Wholesale doing whatever. That there's something in the news that's negative about some leader in some aspect of the mortgage industry. And I hope this doesn't become a train wreck. We invited Matt Ishbia on the Rundown with Rob and Rich on Friday to talk about all this. So no reply yet to our email, but we'll see what happens there. I would be fascinated to have the conversation with them about the strategy and how it's working, and some of the blowback he's gotten and all that. But we'll see what happens there. The another piece of potentially good news, I think it seems like a near certainty right now that FHA is going to lower their mortgage insurance premiums. They came out and said they were going to review it and address it after the end of the first quarter. They may even be reassessing that at this point, with the affordability issue just worsening by the day. Seems likely, right, that we're going to get an FHA MIP decrease?
Yeah, I mean, from my perspective, it seems likely. We were there once before. I think this would be the administration that would happen under. So it didn't happen last time, and I think that's good. That's good for affordable housing. Of course, now that means that maybe March, April, a loan, FHA loan will be as affordable as it was last week.
Yeah, it's like, hey, your insurance premium, monthly and annual, is lower, but there's still no homes to buy. But we'll see what happens there. And then what about, we've seen, there's been a few different reports, including one from CoreLogic, just about fraud in general, right? We're in the cyclical mortgage industry. We've both been through both sides of the roller coaster hill in this industry a few times, and the uphill we're seeing right now, where all purchases and tough to make deals, and margins are shrinking, and home buyers are competing tough against one another. It's the type of environment where you see more fraud, and there's been some reports indicating that, nothing at alarming levels now, but something I'm sure that's on your mind more today as a leader than it was a year ago.
Yeah, I mean, you kind of expect when the market shifts more to purchase away from refi, there's a lot more opportunity for fraud, and it's just the day and age we're in. If I don't recognize a number on my cell phone, I don't answer it, because it's probably a bot calling from somewhere just to test to see if the number's even legit. So and I think that's when people get busy is when guards get let down, and there's those opportunities there. So there hadn't really been an opportunity to let up on diligence in the last couple of years, and I think we don't need to let up. I think it's going to need to get strengthened this year.
Yeah, and I think the thing that's different from certainly 07, 08 is just technology in general prevents a lot of fraud. That prevents a lot of stuff from kind of getting past the goalie. Not all of it, but a lot of the new technology we've seen work its way into the mortgage industry does mitigate a lot of that. But occupancy fraud, a couple of people I've talked with, something that they're more concerned about, I think, going forward. Just somebody, especially with some of the increased costs now on second homes, and that's something you could see a tick up in. Any thoughts on that?
Well, I mean, I guess FHFA helped us out that we don't have to worry about people pretending an investment property is a second home anymore, since they're going to be priced the same. But yeah, I think occupancy fraud is kind of the oldest one in the book, and I think with that pressure on second homes, I think there's definitely a chance to see a lot of folks, trying to buy homes, and maybe it's couples that buy it in one of the spouse's names and try to claim it as primary residence. So I think kicking the tires on that collateral, and the reasonableness of the scenario is going to be important.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the president of mortgage lending for Centennial Bank, Keith Little. We've got about 6-7 minutes left with Keith. Anybody has any comments, questions, feel free to drop them in the chat or the Q&A, and we'll incorporate them into the show. And just kind of moving on to the general business climate right now, Keith. A recruiting frenzy is how I would describe it. I think that everybody is recruiting loan originators. Really, I just, in talking to our members at some events we've been at, and shows like this, and just during the course of these last couple of weeks, extreme focus on operational efficiency with the back office and ways to save costs and be more efficient, and then growing volume. If it's through, you guys made an acquisition of a bank, or recruiting LOs, or a channel strategy, how would you classify the LO recruiting climate right now?
It's pretty hot and intense competition, and we're seeing people send our LOs P&Ls to open up branches, and not necessarily doing as good a market research about what works in different markets, but just kind of throwing offers out there. I think where there was a lot of competition for ops talent that's switching, and there's going to be a lot more competition for sales talent this year. When the markets get tough, that top tier producer, they still do okay. And your top tier realtors have still got houses to list, since there's more realtors than there are houses on the market right now. So those top tier people are going to be in demand, and I think there's going to be a lot of people chasing them. And we've got an extra element this year that how many big lenders went public over the last year, that sometimes the old business models they use may not work. There may be more pressure for return that I think causes even more competition.
Yeah, especially with all their stock prices in the tank. Every single mortgage company that went public is just way down from IPO, and it's going to be interesting to see how they handle that. We talked about United Wholesale earlier. They're way down. I mean, and I've talked to members of ours that are in the wholesale channel, and what they tell me is, man, like between UWM and Rocket, they're just going after each other. They're pricing right into the teeth of this slowdown, and it's just tough to win business. It's tough to be priced right, and that's obviously a market share play and trying to squeeze the other out. But you're a public company now, and every quarter it's all out there for your investors and everybody to see. So going to be interesting to see some retail lenders, Guild and Loan Depot's got big. It's going to be interesting to see how they handle that, because it's a different dynamic being public. We haven't seen a lot of public mortgage companies historically.
No, that'll at least keep it more interesting. It's probably a great time to be an LO. Everybody's always got a choice, and so I think that's where you got to take care of your people and remind them that there are other things just besides a basis point. Execution matters, and for everything that's going to go, everybody focus on efficiencies and stuff. Technology is great, and you can get a bot to process a file that works great, but it's still a relationship business, and you still got to have people.
Yep, absolutely. And along that note, it's like, most mortgage lenders are overstaffed right now. Even ones that grew more conservatively and just weren't throwing money and bodies at all the refi business these last couple of years. Even the ones that approach that more prudently, are overstaffed to some level right now. And just talking to some of our members, they're like, man, I'm okay being like 10-15% overstaffed, but not 50 or 40. But it's kind of a double-edged sword, because right now you're trying to retain your best loan originators. You're trying to recruit new ones. Any good salesperson or head of a division is confident and thinks they're going to do that. So it's, kind of like with the sell a home, buy a home thing. It's like the chicken and the egg. You're out there recruiting, the volume slowed down. It's a lot to manage right now.
Now, the good thing for us is that, I don't know that we're overstaffed. Maybe we're more right sized now. And, just from a moral standpoint, not having to work everybody quite as hard. It's kind of nice if everybody can get a little, catch their breath. There hadn't been any chance for operations to really catch their breath in the last 2 years. No matter what you did, it wasn't enough. There was more coming from every way. So, if everything does materialize, we've got a busy spring. At least if we've got a little downtime right here to retool and catch a break, I don't think anybody's going to complain about that.
And there's no shortage of demand out there. There are so many people that want to buy homes, and if something can move the needle, if it's rates to come down or values to stabilize or something to be done, to kind of help the supply side of things, short term or medium term, it could still be a really good year for purchase, because there is a lot of demand out there. But some of the other things that have come up: fair lending compliance, mortgage servicing rights are flying all over the place right now. A lot of buying and selling of MSRs, non-conforming products. again, on this part of the cycle, volume down, purchase only, wanting to have every product and every tool in your arsenal. Anything in there that is top of mind with you as we get into the heart of winter here?
Well, fair lending compliance doesn't bother me. We've always been overly conservative there, and so when playing fields get leveled, that's always good for everybody. And with the product, sure, when things slow down and it goes purchase, everybody wants to try to get everything they can, but you gotta make decisions like a lot of lenders are doing right now. And okay, you can't be everything for everybody. You got to look at what you're good at, and not, if you try to do everything, you end up being not good at any of it. So
very well said. It's a great point. And yeah, it's every LO wants every product known to man, and and then typically get 6, 8, 9 months down the road and like, oh, we haven't originated any of that. I brought in 3 investors for that. So, but yeah, sign of the times and sign of the part of the cycle we're in right now. But Keith, always enjoy talking about the mortgage industry with you. Greatly appreciate you joining me today. And for those that haven't seen it, our VP member engagement, Faith Howard Mooney, does a great series called Inside the TMC Family, where she picks different lender member of ours each week and does like a little 6-7 minute interview with them about their entry into the mortgage industry and a little bit about them personally. And Keith was the most recent member that we had on that show. That's on our YouTube channel. So it's been a Keith Little February for TMC.
Hard times at TMC. You're having to scrape the bottom of the barrel these days.
But Keith, that's why we love you, man. And thank you once again for joining me. And to all of our attendees, thank you so much for taking 30 minutes out with us. Continue to be here every Tuesday, 2 p.m. Eastern, with the Last Week in Mortgage Today. Until then, have a great week, everyone. Thanks again, Keith.
Thank you. Enjoyed it.
Take care, bud.